What I'm looking to do here is I'll start with the main indicators up here at the top, and then I'll work my way down to these. I'll just start off with SPX here. So starting up at the top here, one of the first indicators I've ever had on my charts and that I use is the Bollinger Band. Now, the Bollinger Band on my chart, first let me pull up the studies so you guys can actually see what they're set at. So you can even see here that they're the first ones I added to my chart whenever I was doing it here as well. And I have 2 sets of studies for the Bollinger Bands. That's what makes each of these lines, right? One is on the inside, and that is the 2.0 deviation, right? The second deviation. So it's set with a length of 20, which is what it's normally set at. And then the deviation number here is a -2 for the lower Bollinger Band and a +2 for the upper Bollinger Band. That's the second deviation Bollinger Band. The outside line is the third deviation Bollinger Band. Now the length is still set at 20, right? That's why they kind of parallel each other. But one is looking at the third deviation versus the second. So once again, those settings on the inside are a -0.3 for that lower third deviation Bollinger Band and a +3 for the upper. And then the color I chose was just a blue for both, and I do not plot the midline. The reason why I don't plot the midline is because I like my simple moving averages in there. That's what I mainly use. So the midline to me just gets it a little bit more cluttered, so I don't pay attention to it as much for myself. The reasons why I use the Bollinger Bands. Well, first of all, as you may be able to tell when we zoom out here, the price, the underlying asset price, typically trades within the second deviation Bollinger Band. That's what I like to call its comfort zone. And Bob, yes, it's technically 2 studies. So Bob's asking, do I always use 4 Bollinger Bands? And I get what you're saying there. Yes, technically it's 2 studies. So one set of Bollinger Bands is the second deviation, and one set of Bollinger Bands is the third deviation. So technically it's 2, but yes, there are always 4 lines. So the reason why I mainly track the second deviation Bollinger Band is because you can see that's the price's comfort zone. That's where it mainly trades in. So that's one of the reasons why I track it. I know when it's in there, it's in the comfort zone. If it starts to exceed the second deviation Bollinger Band, it typically does not like to trade outside that level for very long. Let's go back to a bit more of a normal, less volatile market, right? So we can see here, for example, the price moved outside the second deviation Bollinger Band down here, was outside for 2 days, and then moved back up inside that level. Over here, we traded outside of it for about 4 days, right along that level, consolidated back in, traded one more trading day outside that level again, but then went back to mainly being in that second deviation Bollinger Band. So you can see for the most part, it doesn't like to trade outside that level. And the metaphor I always give with this is imagine that you're in skiing, right? Or you're in a snowy mountain town, maybe you have a log cabin and you're inside with a nice hot chocolate cup, or maybe you have a hot tub there and you're in the hot tub and you're relaxing, you're all nice and warm. And then let's say you go outside and decide to do a snow angel, right? Well, sure, you can be outside for a little bit and do a snow angel like that, but you'll eventually start to get cold. It's not your comfort level. So eventually you'll want to go back inside the house. You'll want to jump back in the hot tub and be back within that warmth for your body temperature. And so that's a similar situation here, right? We might trade outside of it for a little bit, but it's not the comfort zone. The reason why I track the third deviation Bollinger Band, and let me see if I can pull up a better chart to help show this. Maybe the weekly time frame will give that to us. Yes, so the reason why I track the third deviation Bollinger Band is because when the price not only exceeds that first comfort level of the second deviation Bollinger Band, but it also exceeds the third, which is outside here, that means it was in particular a very strong move. And when it exceeds that third deviation Bollinger Band, depending on how the bar closes, what that basically could mean is, first of all, it always means that the price might stay within the current bar's trading range, right? So in this case, when we made this first third deviation Bollinger Band snap, we exceeded that level and moved outside of it with the underlying price. There was a good possibility we would stay between 28.82 of the high and 24.78 of the low, which, you know, in this case was a very wide range, but that's the point. We would stay roughly within that. Now, the other way that means is that, especially on a bar like this, where we're not making a bullish divergent bar, it's just a nice red bar. And we'll go over what that is in a second. But if it's making just a strong red bar, we close near the low of that bar, in particular, while making a third deviation Bollinger Band snap, that means there's also a high probability that we will continue in that direction. So in this case, because it's on the lower Bollinger Band, that means we will continue to the downside. And the reason why that is because in particular in this case, right, the sellers ended up outweighing the buyers very strongly to where the price not only exceeded this level, but this level. Once you start to exceed this third deviation Bollinger Band, there's almost a bit of fear / FOMO happening within traders' minds. Some of them are like, man, this is moving lower. I don't want to miss this, right? It's such a strong move. It's definitely going to continue down. There are people who are in here saying, oh my gosh, this is a drop. We're going to continue lower. I need to protect myself. So they'll be getting out of trades. And in turn, that FOMO is what continues to keep the price down. Now, if it makes a bullish divergent bar like we see here, which, like I said, I'll talk about that in a second, but just in regards to the third deviation Bollinger Band snap, if it makes a bullish divergent bar, then there's still the probability that you'll see that consolidation within the same price range, but there's also a probability that might be the pullback to get back within the comfort zone, right? It still has that possibility of following through on a higher high. So you want to be a little cautious when you see this. Like this one, for example, I would have been a little cautious about trying to continue with a bearish move. In case we did follow through to the downside, made another third deviation Bollinger Band snap, a strong red bar, followed through with a lower low. In this case, we made that bullish divergent bar. And notice how for this week, yes, we did technically get a little bit higher. So that divergent bar technically followed through this week. Our high last week was 2637.01. Our high this week was 2641.39, right? So we technically followed through with a higher high, but notice how it stayed within that trading range, right? So it's basically consolidation. And of course, if the price is consolidating, what that is allowing overall for the Bollinger Bands to occur is to flare open like they are to catch up with the price, right? Because the Bollinger Bands want to keep the price within that second deviation Bollinger Band. So this is another reason why we track them, because it kind of gives you an idea of, okay, is the price consolidating? Are we trading in a bit more narrow range? Or is it starting to flare open so it's anticipating a bit stronger of a move? A lot of times you'll see when the squeeze occurs that the Bollinger Bands will flare open to the upside, right? Like, and for this, for example, because the squeeze fired up. So you'll see the Bollinger Bands flare open because it's a greater than expected move. So it's trying to make room for the price to stay within the comfort zone and still continue in the price direction where it wants to go, right? We didn't have a squeeze, but we definitely got our bearish signals to the downside. We started to break support, and now the Bollinger Bands are trying to keep up with the price. Now, let's say, for example, like back on the daily chart, the Bollinger Bands start to flatten out like we're seeing here. Well, if they start being a less dramatic flare open, if they start to flatten out, that's usually a good sign that we've at least found some sort of bottom, and we'll either start to pull back within that move down example for the here, or we'll start to see consolidation overall. So in this case, we had a small bounce back up, and right now we're in consolidation. And that means the Bollinger Bands are coming back together to meet with the price because they're not anticipating a strong move one way or the other. So that's always good to see. And then of course on other charts, like for example, Netflix, I know on the monthly is like this. So Netflix, you know, it has this nice bullish sentiment starting to appear, but notice the Bollinger Bands remain flat. The fact that they're not starting to flare open is a sign that at least as of right now, they're not into a move higher than the second deviation Bollinger Band, which is right around 400. That's that psychological level we keep hitting on Netflix and stalling at. So in this case, right, the Bollinger Bands can also help us identify when they're maybe not anticipating a move to the upside, and it's going to be more a quarter resistance. Great example was down here, right? Once again, we saw a move down in Netflix, but the Bollinger Bands did not show any sign of flaring open or trying to make room for the price to move lower. Instead, it remained completely flat. And so it held itself as a support. We saw the bounce back up. And this too is showing on the Bollinger Bands at least signs of consolidation. And it's matching up with what the 10 and 30 are doing, which are converging. So that is what I look at for the Bollinger Bands. Mark, you didn't miss me talking about bars. We'll get to that in a second. But that's the first indicator I have on my charts are the Bollinger Bands. And those are all the different things I look at whenever I'm using them. And of course, you know, it can help also show an overall channel, right? Like this, for example, we continued to open up the Bollinger Bands to the upside. So it was showing that bullish sentiment at that time. And now we've started to go into a very wide range of overall consolidation on the monthly. So the next thing on my charts, let's go back to SPX here, are the simple moving averages, right? The simple moving averages on my charts, let's pull up the studies again. So for myself, the three that I use are the 10, the 30, and the 100. Now, other traders here use the EMAs. I just like to use the SMAs, the simple moving averages myself, just because that's what I started with trading. I know whenever John and I were comparing charts when I first started here at Simpler Trading, you know, I was just showing him what I used. He was showing me his charts and his indicators that he used. And we the two EMAs that he uses, I think it's the 8 and 21 or something like that here, is very similar in movement to the 10 and 30. So they're not too far off from each other. But one of the first indicators I had on my chart along with the Bollinger Bands were these simple moving averages. I also added on the 100 period simple moving average because that to me can be a great trend support and resistance level. Now, on my charts in particular, all of my simple moving averages are this goldish yellow color. That tells you on my charts that those are all simple moving averages. The short dashed line is my 10 period simple. So that one's my 10 period simple moving average. The longer dashed line is my 30 period simple, and the solid line is my 100. So you can see it works itself up from smallest being the dashed to the longer simple moving average, the 100 period simple being the solid line up at top. So reasons that I use the simple moving averages, first of all, they can act as support and resistance levels. So here in this case, the price was trading below the moving averages. We broke them as support, turned them into resistance. The price went up and tested the 10 period simple. It held as resistance, and that was a signal to look at going short and play it back to the downside. Then we broke above the 10 period simple, and right now it's attempting to hold as support. It's a little bit weak here in my opinion, but that's what it's trying to do. You can also see as well, the price will sometimes consolidate along the moving averages, right? Sometimes as it tests support and resistance, it stalls there for a few days, in this case on a daily chart, and that's what we're getting here. So it's also a level that the price can stall at and kind of test for a little bit before it determines whether it's going to break above it in this case, or hold it as resistance and continue lower. So those are the reasons why I track the simple moving averages, right? In SPX in particular, a lot of the times it does respect that 10 period simple pretty nicely whenever it's in bullish or bearish trends. Here you can see that was the main level of support, and then we, might go down to the 30 or the ATR trailing stop. But typically that 10 period simple, in particular on SPX, holds quite nicely. So, and you can see the same thing happen down here whenever we start a bearish trend. The other reason why I track the simple moving averages is because they show an overall trend direction. And what I mean by that is you'll either see the simple moving averages ideally stacked, in this case, down. So what I mean by stacked down is that the lowest time frame is on the bottom, working its way up to the highest time frame. So here's the 10 period simple moving average, followed by the 30 and 100. So that is a stacked down formation, and that usually indicates a bearish trend, right? That's what we're currently in. When you see the opposite, and it is the 10 period simple up top, the shortest time frame up top, working its way to the bottom. So the 10 is trading above the 30, both are trading above the 100. That's usually a stacked up formation or a bullish formation on the simple moving averages. So that usually means you're going to see movement to the upside. Let's say the simple moving averages are kind of trading right by each other, right on top of each other, or maybe the 10 period simple is in between the 30 or 100, or the 10 is below the 100, but the 30 is not yet below it, right? So we're not technically stacked up or stacked down formation. This means that we're in consolidation, right? This means that the price overall is taking a breather, and oftentimes indicators are themselves or will start to be in a bit more of a choppier range. So you can see back here, I mean, it was a wide range, certainly. Well, maybe not compared to now, but back then, I remember this because this is going into when my daughter was born. So I was doing these Divergent Bar trades during that. And we can see here around 28.40 up to 30.16, right? It was a wide range for that time, but that's where we consolidated before we started to go back into a bullish trend and then started to continue to the upside into those new highs. So that's why I track the simple moving averages. The next one I want to talk about is the ATR trailing stop. I know I've had quite a few questions about this one in the main room, so I'll be happy to pull this up. Let me first pull up the studies. So the ATR trailing stop, I'll dive into this one in particular. I changed the colors from its natural settings. So for myself, I use red as technically the buy color and blue as the sell. Now, I don't look at it as anything in regards to buy and sell, but those are just to let you know the colors I use. The line itself I've drawn as dots just to help me differentiate that between the Bollinger Bands and the simple moving averages, right? It's easier to kind of see on my chart here when it's a dotted line. So that's a difference as well. The numbers should stay the same as when you add the study from Thinkorswim. So the ATR period is 5. The ATR factor is 3.5. So those are the changes I've made within the study itself, is mainly the colors and the way I draw the line. And then, of course, if you're on a different platform and you need to change the numbers, you know what they are up here. So the reason why I track the ATR trailing stop, this is not one of the, I've had this on for several years now as an indicator. So it's not necessarily a new study, but it's definitely newer compared to the Bollinger Bands and simple moving averages, right? Those are two that I've always had on my charts. So the ATR trailing stop's relatively newer. The reason why indicator is, first of all, it can help show support and resistance levels. So let's look at this on a monthly chart because this is pretty clear on SPX and monthly. So overall, it can show support and resistance levels, right? Here, for example, the price went down, tested this blue dotted line ATR trailing stop, held it. It was a nice support. We bounced back up. Here, once again, tested that level, held it, bounced back up in the trend. Here, more recently, we tested it. We actually trade the month below it. But as long as the bar closes above that level and it still prints support, then it's still holding on. It does mean it was a little bit weaker. I've been a little cautious, and I was whenever that happened in 2018. I was like, okay, let's watch into January, guys, just to make sure it doesn't break the next time. But the fact that it held it still means that it was holding us support, and we did follow through with that bounce up then. So good sign of support and resistance. Back here, for example, the ATR trailing stop acted as resistance from the start of 2004 until about November of that year when we finally broke above that level. So it can act as resistance. So support and resistance, I usually use that a bit more on the daily chart as well. But you can use it on any time for weekly, monthly. If we go to that level, stall, and then start to bounce, you know, it's holding. Great time to jump back in to the upside, or, you know, maybe a credit spread or something like that to the downside. If it starts to break the ATR trailing stop, and for example, here last month, we broke the support level, which means we turn it into resistance. You can see that dot changed from a blue dot, which is support to me, and changed it into a red dot, which is resistance. When you see that occur on the longer time frames in particular, usually on the weekly, and certainly in this case on the monthly for SPX in particular, it means that we're getting probably a bearish trend, right? On SPX, the only time on the monthly time frame we broke these levels was back here during 2000 dot-com bubble into early 2000s and 2008. So the fact that we broke it definitely has me cautious that we're moving lower. On a weekly time frame, for example, whenever you get the switch, particularly from resistance into support, this is usually the signal I like to look for on a weekly. You can see that it usually indicates a bullish trend, and it's typically a good sign for a longer term period trade to look at going long, right? Maybe a leap or buying into shares or something like that. And you can see here we had a nice run and move to the upside. I think this also happened not too long ago on Hershey's. Yeah, so Hershey's back here, switch to resistance to support, nice run to the upside. Now you might want to, you know, do some homework, see how often it follows through on a bullish sentiment, right? Sometimes it might not follow through as nicely. Amazon, I think, typically follows through. So here, for example, we had the switch, nice bullish sentiment move. Here we had the switch from resistance to support, very nice move to the upside there. Here was one time it didn't quite follow along, as well as here we did have a short run up before we ended up pulling back and breaking during this market. So sometimes it can make a great entry signal to go long. So that's another reason why I use the ATR trailing stop. And then the last main study here on the main chart is my divergent bar indicator. So all these other studies I talked about are free studies on Thinkorswim. The Bollinger Bands, the simple moving averages, the ATR trailing stops, all of those are free studies you can add to your chart yourself. The divergent bar indicator is not. This one, paid study that Eric helped me create from a signal that I looked at for a while. It requires some math in order to understand whether or not it's making a divergent bar. And I was like, I'm tired of spending all this time doing this math rather than just letting it, print a certain color and just having me quickly know whether or not it's trading as a divergent bar. So let's kind of talk about that for a second. A divergent bar, it's better usually when this isn't a trend. Let's go to Tesla actually. So a divergent bar, sorry guys. The only thing I changed on mine really quickly, let me pull up the study itself. Eric set these as slightly different colors. Let me go down. So they're going to be a little bit different for myself. And you'll want to go to globals. That's so you can use the scanner on it. So you can ignore the plots. On the global colors, that's where you can change it. For the divergent bar high, I changed mine to a light pink red color because a divergent high bar means it's a bearish divergent bar. So it has bearish weight, meaning we're going to see a potential lower low. We'll talk about that here in a second. The divergent low bar is technically a bullish divergent bar. And for me, I made that a light green, blue color here. Because that, in my mind means, okay, we'll probably see a move up. So let's go back here, right? I like to open a divergent bar that's in line with the trend. So in the case of the bullish divergent bar or that divergent low bar, I'm looking for it typically in a bullish trend because it has better follow through of working out. So what is a bullish divergent bar? Well, a bullish divergent bar typically means that your price bar has seen a lower low compared to the prior trading day, in this case, that printed. So we had a lower low, but buyers came back in and pushed the price back up above that 50% trading range. So that makes a bullish divergent bar here. So for me, instead of having to do the math to make sure, sometimes it prints right around that 50% line like it did here, for example, or like here or here even. So instead of having to sit there and do the math to confirm, Eric has made it very easy for me to just be able to have the bar print a certain color. And that way I know rather easily what it is rather than spending the time to confirm the information. So in this case, we had a bullish divergent bar right off support. Typically what that means is that we'll see some sort of follow through of a higher high compared to this current bar within the next 3 bars that it prints. So on the daily chart, that means within typically the next 3 trading days, we'll have some sort of higher high. So this bar's high was 564.44. The next day we got to 576.81. So it definitely followed through then. And then of course, when it's in a bullish trend, you have that flexibility of continuing to hold on to play with the trend to the upside. Back here was another bullish divergent bar with a high of 818. Now the next day it didn't follow through. It only went up to 812. But that second trading day, right, 3 for it to work out. The next one went up to 860 and we followed through beautifully, locking in a profit. So that's the bullish divergent bar. The bearish divergent bar, like we can see here, for example, typically indicates some sort of lower low. So remember when we talked about the third deviation Bollinger Band snap, and I said, unless it makes a divergent bar, there's a good probability it will continue in that direction. So in this case, right, we made a nice strong green bar. It did technically make a third deviation Bollinger Band snap. The bar price traded above that level sometime that day. And so therefore we got follow through of a higher high, but this one closed in a bearish divergent bar. So it still had the possibility of consolidation, but it also had a possibility of moving back down because it is a bearish divergent bar. So a bearish divergent bar is when you have a higher high compared to the previous bar, but sellers come in and weigh it down in that bar, closing it in the bottom 50%. And that in turn usually means you'll see some sort of lower low within the next 3 bars. So this one worked out well. This to me is technically a counter trend signal because it's a bearish divergent bar, but it's in an overall bullish trend. Usually when I see that, it's because I'm bullish and that's a signal for me to take profits off the table. I usually don't take a counter trend signal to play to the downside. Doesn't mean it won't follow through and can't work out. It did beautifully. Here, for example, though, it was a bearish divergent bar right into support. You can see that signal never followed through within 3 trading days. So this is why I look for bearish divergent bars more in bearish trends, or sometimes, I'll take these trades in more consolidating trends too. But for today, for example, it's making a bearish divergent bar. Typically, I will note, I don't like trading these trades on Fridays because weekends can, at least on a daily chart, because weekends can really throw things off. So typically on Fridays, I look at a weekly chart for divergent bar trades to jump into. But if you really felt the need, if you did like resistance here, right, this is giving you a clue that within the next 3 trading days, maybe into next week, we do see some sort of lower low compared to today, which is at 482.50. Now this bar signal doesn't print until the close of market. So for myself, using the overnight profit strategy, I typically don't open these trades until maybe the last hour on a weekly bar, but typically the last minutes ideally is when I'm looking at opening these trades, because I want to confirm the bar printing is a strong likelihood, right? I want to make sure it doesn't go back against. So the last 2 indicators up here are the multi-squeeze indicator and the multi EMA indicator. And very quickly, for the multi-squeeze indicator, I have it on time. I didn't change anything about the studies. The ones that I have, though, are for the 10-minute chart, the 30-minute chart, the hourly, the daily, the weekly, the monthly. So in that sense, some of these are for my intraday trading, right? The 10 up into the hourly is for my intraday charts. And then daily, weekly, monthly, I like for longer swing trades to the upside. If it's green, like it is now, that means we're not printing a squeeze. If it's red, that means we're printing a squeeze. So this can very quickly let me know if there are squeezes happening. Like on Kroger, for example, there's a daily and weekly squeeze. So this is when I'm actually keeping an eye on. I will talk about this in the main room, but I'm looking at potentially a trade here to play to the upside. If you were at the end of day stock picking session last week, you know that this was one that was already on my list to be bullish. And if you had jumped in after that day, whenever it proved that it held the 100, you would have already, be in this for a very nice profit. But if you haven't jumped in yet, I still like it to the upside, which is why I want to talk about it. Yeah, Bob, so you're in it. Great job then. It still looks good. The multi EMA is to show, in my case, whether the 5 is above the 21. Once again, same time frame. So I have this on the 10-minute chart, the 30, the hourly, daily, weekly, monthly. And if the 5 EMA is the shorter time frame, the 21 is the larger. We don't have SMAs, otherwise I would choose that. So I just keep it on the shorter time frame EMAs. But when it's green, that means the 5 is trading above the 21. If it's a light green color, that means the 5 is just starting to cross above the 21, but hasn't completed the cross as of yet. If it is a dark red color, like we see here, that means the 5 is already traded below the 21, and it's a more bearish sentiment. If it's a brighter red color, like you see here, that means the 5 is starting to cross below the 21, but it hasn't completed the cross yet, so it's getting ready to turn bearish. So I like that because that can just help give me a clue about if there's any weakness or if we're still potentially in a bullish trend or bearish trend on the longer time frames without necessarily having to flip to them. No, Mark, I would say they work both in the Bollinger Bands with not. Now, you still have to be cautious within the Bollinger Bands or when they're outside the Bollinger Bands because it's technically outside of its comfort zone. That's a great question. So with the divergent bars, do they work better outside or inside the Bollinger Bands? They still typically follow through. A great example is of NFLX, where on the weekly chart a while ago, we actually made a bullish divergent bar and technically had a Bollinger Band snap to the upside as well. But this was a great signal to look at going long. And you can see by that second week, that second bar, it followed through with the higher high beautifully. So it can make a Bollinger Band snap and still follow through. For me, in particular, what I want to make sure is that it's usually with the trend. So bullish divergent bar, I like that with the bullish trend. I wouldn't have taken the bearish divergent bar signal here. So if we were in a bearish trend like here, then yeah, I would have looked more at a bearish divergent bar, right? Because we've broken support and are turning it into resistance, and our next support is a ways away. So the lower indicators, let me go over those really quickly so we don't hopefully miss anything out here. The first lower indicator down here is the Awesome Oscillator. This is one of the few indicators I have been using since the very start of my trading career. So this has been on my charts as long as my Bollinger Bands and my simple moving averages. This is why I personally still keep it on my chart. Some people just have the squeeze on their chart. You can see that they're very similar, but they do end up being slightly different. Now, once you add the Awesome Oscillator to your chart, you shouldn't have to change anything about it. I haven't changed, any internal settings. I just add it. It's good to go. The reason why I like using the Awesome Oscillator, other than just I've used it for a while, is first of all, it can tell you if there's bullish or bearish sentiment. If the bars are trading above the 0 line, that is bullish sentiment, which is this red line right here. If the bars are trading below it, that's usually bearish sentiment or maybe a pullback that's occurring. Now, as you can see here, we'll have moves up and then we'll get maybe some red bars. When we see red bars and it goes back down towards the 0 line, like this, for example, it usually means that the price is either pulling back as well down to a support level to test it, or it's consolidating. This is basically allowing the momentum bars to reset and then potentially continue up. So once we show that we're continuing to hold the 0 line, we see the bars build back up. That's usually a sign that support's holding, a good opportunity to buy back in, play it back to the upside. When the bars start to reach the top of the axis, like they did here, for example, and we start to see red bars form again, that is a sign of exhaustion, right? So that typically means that the price has found a top and will more than likely see some sort of pullback or at least take a breather there once again and consolidate. In this case, Netflix ended up pulling back. When you see the bars cross, so in this case, when they cross from above to below the 0 line, that is a bearish sentiment. That means we're turning more than likely bearish, or we're definitely going to see a move lower in the price. So as you can see here, the bars crossed below the 0 line. The price continued all the way down into the 100. Now notice down here, the bars are at the bottom of the axis. Once again, even though it's bearish, that is a level of exhaustion. So that means the price is either going to bounce back up or it's going to consolidate some. In this case, the bars moved up, we bounced back, and then actually went into some consolidation here. So that's bullish and bearish sentiment. Now, the last thing on the momentum that I watch is when the bars are barely bars, right? When they're kind of non-existent or flat against the 0 line like they are here, whether it's above or below it, that is usually a sign of consolidation within the price. So that is the Awesome Oscillator. So those are the different ways I use it for potential exhaustion levels, to determine whether it's bullish or bearish sentiment, or whether it's changing into bullish or bearish sentiment, as well as consolidation. The Compound Breakout Tool, this is another indicator where you shouldn't have to change anything except for maybe the color on it, right? If you're colorblind and you need something other than red and green, totally understand. That's the only thing to do here on the Compound. This is another indicator that is not free. So the Divergent Bar indicators, the Multi Squeeze, the Multi EMA, and the Compound Breakout Tool, those right now are the main paid indicators on my chart. Everything else, this is the normal squeeze here. So everything else you can get on Thinkorswim. The squeeze, depending on your platform, you may have to pay for that. But if you have Thinkorswim, it's one that Thinkorswim actually pays for all their users. So it's already on there for you guys for no charge. So the Compound Breakout Tool, the reason why I use this is actually a combination of several different studies I used to use and the different signals I looked at each study. Basically, on these 3 studies, which is why there are 3 lines plotted here. One is the multiple simple moving averages, one is the stochastic full, and one is the MACD histogram. On each of those studies, I looked at certain signals, but those signals I wanted to be in line with the signals I saw in the simple moving averages and the signals I saw on the stochastic full or MACD histogram. I wanted those signals to be in agreement with each other for it to be an overall valid signal for me to jump into. And I know that sounds confusing. My charts look just as crazy. So when I started here at Simpler Trading, they told me Eric's great to go to if you want to try and simplify your charts, or if there's a signal that you're looking at, he might be able to set you up with an indicator encoding to view it in a much easier way. And so I told him all the things I looked at on these indicators. I told them how they had to be in agreement with each other versus when they're not in agreement, when they cancel out. And he made the Compound Breakout Tool for me. So on this indicator, right, it doesn't matter which line is what for what, prior, study it was. What matters on this indicator is it printing 2 signals or 3 signals? 3 means all of them are in agreement. Typically, you'll get a little triangle down here for that confirmation. If you get 2 signals in agreement, at least, you get these dots to print until you get all 3 to print or until it cancels out. So when you get all the green boxes in a line, or at least 2 of the 3 green boxes in a line, it usually means you're having a bullish sentiment. If you're already in a bullish trend when that signal prints, it usually means that you're going to continue a bullish trend, and it's a good sign to go long to the upside. When you get a bearish signal and a bearish trend, let's go to SPX. I think there's a signal on that. Yeah, so when you get a bearish signal and start to go into a bearish trend, that usually means you're following through, right? It's a valid bearish signal to jump into. Now, let's say you get a bearish signal like this, but you're in a bullish trend. Well, the compound breakout tool is basically telling you, hey, right, you have 2, or in this case, all 3 in agreement with each other. So what it's letting you know is, hey, we're probably going to see some sort of pullback down to a support level and test it. If we continue to break support and this signal remained valid, much like it did here, that's when it turns into a bearish signal. But if it's a bearish signal, we move down to support, like in this case, we moved down to the 30 and we held it, and then all of a sudden that signal canceled out because it printed a green box. So that means that signal satisfied itself for the move down into support, which was the 30. And then in this case, we're bouncing back up into a bullish trend. So when it's a counter signal, kind of like the divergent bar indicator, right? When it's a counter signal that's printing, that's usually a sign for me of, hey, look at potentially testing profits, and also look for a potential entry to jump back in. So in this case, right, we pulled back, the 30 was holding, we started to bounce. Once either that signal started to cancel out, or maybe I liked what I was seeing on some of my other indicators, that to me would be a sign to say, hey, let's go back to the upside once again. The last thing really to note about the divergent bar, the compound breakout tool down here, is when they start to print back to back like this, whether it's one box printing back to back like it is here, or when, it's technically a valid signal, but they keep canceling each other out. So here was technically a valid bearish signal. It immediately canceled into a bullish one, which then immediately canceled into a bearish one. During that back-to-back trading of it, that is typically a sign of consolidation. So that usually means the price is trading flat, or it's trading within a choppy range when you see that. So from there, you're usually looking for a bit more of a valid signal here. Once it started to print the next day and remain valid, that was a good sign that we were going to drop off, which we did. And then we started to turn flat and then went into a bullish signal up into resistance there. Then our signal started to chop, right? Got a little choppy there. So we were trading flat, and then we printed this valid bullish signal, and then that started to see us move a bit more to the upside. Certainly there are better signals here and here. So I like this indicator. I use it on my smaller time frames to help me with intraday trading when I know, like for example, here we're in consolidation. Here we're seeing the price trade within this flat range. Of course, sometimes we're not in consolidation, right? We're getting a bit more of a trending signal. So here, for example, was a nice bullish signal. We saw a great move to the upside. Now, once again, we had resistance levels above us. So it was first a sign saying, hey, we're testing resistance, but then we higher from there overall. And then last but not least, the squeeze indicator. So the squeeze indicator, whenever it prints red, just like it would switch to red here if it was printing a squeeze right now, that usually means that you're in a sign of consolidation and you're about to see a greater than anticipated move once the squeeze starts to fire. So that's usually a good sign to look at potentially going long on a trade or jumping into a bullish or bearish trade, depending on, usually I look at the other indicators to help determine, okay, which way do I think this is going to go? In this case, we were mainly in a bullish trend. Momentum was above the 0 line. Didn't have a signal here, but everything looked good for that squeeze to fire up. And you can see we moved to the upside once it fired. And what I mean by fired is that it went from red back to green dots again. So that's the main thing I use the squeeze for. Like for Kroger, for example, right, we have a daily and a weekly squeeze. The weekly chart is turning bullish. Bollinger Bands are flaring open. Momentum is above the 0 line with the green bar for this week. Still don't have a valid signal here, so that makes me a little cautious. This is more consolidation. But it's not surprising to see a consolidating signal when you're printing a squeeze. If we started to then print from here a bullish signal like we did back here, that to me would be a better clue that, okay, the squeeze will probably fire up, which in this case it fired right into resistance, and then we dropped back down. Hey, Allison Ostrander here, Director of Risk Tolerance at Simpler Trading. Thanks for watching the video. If you enjoyed this video, please be sure to like and comment down below to help us out. Also, be sure to subscribe and click the bell icon so you can get notified when we release our next video. And if you want to watch us trade in real time using our own money, go to simplertrading.com to learn how to sign up. As always, may the trade be with you, and we'll see you in the next video. Bye.